Okay. Good afternoon, everybody. This is Chuck Hughes. Welcome to our continuing series of webinars on the Inner Circle strategies in implementing the Inner Circle trade recommendations. Today, we're going to focus on the fundamental indicators we use to select stocks. And just as a background for this presentation, for a long time now, stocks have been traded more or less as a commodity through the use of S&P futures and ETFs based on events that occur overseas, especially in Europe. So for a long time, stocks were traded as a commodity, and it was risk on or risk off every day. However, we're starting to get back to normal, what I call more normal market conditions, where the fundamental indicators of a stock matter, and stocks now are starting to trade more on their fundamental indicators and less so as a commodity. So if we use fundamental indicators in conjunction with our technical indicators, we can get a real edge in this market and select stocks that can really do well in this type of environment. So in previous webinars, we looked at our technical indicators, our trend following systems, and we use the 50-day, 100-day EMA, the MACD, MACD, and of course the major trend system to identify the price trend. Then we confirm the price trend using indicators such as the on-balance volume and the 52-week high list. And then we use the Keltner channels to determine our entry point. So these are the technical indicators we use, and I like to combine them now that stock picking works again. I like to combine that with our fundamental indicators. And I use several fundamental indicators in conjunction with the technical indicators to help select stocks or companies with the best profit opportunities. And this has been working real well for us, as you'll see. So as far as fundamental screening, over the years, I like to look at the growth in equity for a company. That's always a good sign if a company's healthy and growing its earnings. I like to check the growth in retained earnings, and then I like to just verify those two growth rates with the revenue growth. And we'll look at that in a minute. And also, we use dividend growth. That's another great fundamental indicator, and we use the dividend growth for our dividend portfolio. So equity growth is a great fundamental indicator. I've learned through many years of experience that companies that have a high rate of stockholders' equity growth normally provide the best investment returns over time. So there's a strong correlation between high equity growth rates and high returns for companies. And the stockholders' equity is calculated by subtracting a company's debt from its assets. So essentially it's the breakup value or net worth of a company. And when a company produces earnings and it's able to retain those earnings, it increases stockholders' equity. And retained earnings are normally the largest component of net worth or stockholders' equity. And when a company is able to grow that stockholders' equity or net worth, it creates economic value for its shareholders and makes a company's stock more valuable, because when you buy stock, that's what you own. You own stockholders' equity, and you own it in proportion to the number of shares you own in the company. So it's a great way to track the financial health and the earnings power of a company is just simply to track the stockholders' equity. And as stockholders' equity grows, a company can increase its productions or services. For example, banks can increase their loans, insurance companies can write more policies. So this increase in production or in services can in turn create more net income for the company. So a company that's growing its stockholders' equity is creating real wealth for the shareholders. And companies that produce and are able to retain their earnings have always enabled stocks to provide the best returns compared to all other types of asset classes. And this stockholders' equity has always allowed stock investors to enjoy the highest returns on investment. And as long as companies continue to produce and retain their earnings, stock investing will always provide superior returns to all other types of investing. So ultimately, it's the reason why we invest in stocks. It's this growth in stockholders' equity. And as I mentioned, my actual trading experience and historical research demonstrates that there's a strong correlation between the growth of a company's net worth or stockholders' equity and the price appreciation of its stock. And we'll look at some examples of that here shortly. And historically, the market price of a stock normally follows the growth of the company's net worth or equity. And the growth in stockholders' equity has created trillions of dollars of economic value to shareholders, and it's, when you think about it, it's the foundation of a capitalist economy. So the stockholders' equity is what allows companies to initially be created and allows them to grow. So we want to track that stockholders' equity. That's a great fundamental indicator. And as the company's net worth grows, the true value of your stock investment grows. So let's take a look at how we can determine what the stockholders' equity growth is. And I normally use two sites for this: Google Finance and Y-Charts. And I'll show you an example of ycharts.com in a second. First, we'll look at downloading stockholders' equity through Google Finance. And you would log on to Google Finance, type in the stock symbol. In this example we're looking at right now, we'll use Clean Harbor's symbol CLH. So you want to type in CLH, the stock symbol, click Get Quotes, and then you'll get a quote for the stock, and then you want to click Financials. And when you click Financials, then you want to click through to Balance Sheet and Annual Data. And this will show you the balance sheet for the company on an annual basis. And they show 4 years of balance sheet information. So over that 4-year period, you can calculate what the equity growth rate is. And so if you click Balance Sheet and Annual Data, you'll get the balance sheet information for the company. And if you look towards the bottom, you'll see the equity figures for the company. And for Clean Harbor's, as of December 31st, 2007, they had $202 million in total equity. And all these figures are in thousands of dollars. And then 3 years later, on December 31st, 2010, they had $780 million in total equity. So if we subtract this starting balance of $202 million from the $780 million, we get a net increase of $577 million in shareholders' equity. And then if we divide that 577 by our starting value of $202 million, we get a factor of 2.84, multiply that by 100, and then that'll give us the percentage gain over this 3-year period. From 202 to 780, that was a 284% gain in stockholders' equity. And then, again, that's over a 3-year period from 07 to 08 to 09 to 2010. So if we divide by 3, we come up with an annual percentage gain in stockholders' equity of 94%. So obviously, this is a very healthy company. It's able to increase the net worth of the stockholders' equity of the company almost doubles every year over that 3-year period on average. So this is a sign of a very healthy company, and a company that's able to increase its earnings, and more importantly, to retain those earnings. And here's an example. This is a great website for fundamental indicators. It's ycharts.com, and with ycharts, they have dozens of fundamental indicators, and you can get them for over 5 or 10-year periods, or even longer if the stock has a longer history of data. So you can get some long-term fundamental data on this website. This is a great website for examining the fundamentals of a company. And what you do is, in this case, I selected Apple stock, AAPL, and then under comparison metric, I selected shareholders' equity. And what this does, it gives you, in this example, this is a 5-year chart, so it gives you the 5-year price of Apple stock, and then it also gives you stockholders' equity, and that's this line right here. So you get a great picture of how Apple's been growing its stockholders' equity. You can see it's been a very consistent growth in stockholders' equity. And when you're on the site, you just take a cursor and you can find out what this ending value is for stockholders' equity, and then you go back to the beginning value, and you're able to calculate the percentage gain over that 5-year period for in stockholders' equity for the company. And in the case of Apple, it's grown its stockholders' equity at an average rate of 118% annually over the past 5 years. So if you take the ending value, subtract the starting value, divide by the starting value, you can calculate the percentage gain. And in this case, it's a 5-year period, so we divide that by 5, and the average annual gain in stockholders' equity has been 118%. So again, another very solid fundamental company if it's able to grow its stockholders' equity or its net worth at that rate over a 5-year period. Here's another example of stockholders' equity. This is for Baidu, and again, this line represents the growth in stockholders' equity. You can see again a very consistent, strong growth in stockholders' equity, and then this is the stock price. So those are the two sites I normally use to download stockholders' equity, and we use stockholders' equity as one of our basic fundamental indicators when we're looking to buy a stock in the stock portfolio. Now, another fundamental indicator I like to use more or less to verify the growth in stockholders' equity is the revenue growth. And this is also available on ycharts.com. And again, they allow you to choose a metric here, and I chose the revenue per share trailing 12 months. So again, it displays the price chart for Apple stock, and then it also displays the revenue per share over that 5-year period. And again, you can take the cursor, get the ending value of the revenue per share, subtract the starting value revenue per share, come up with a gain, and then divide it by the starting value, and you come up with a percentage gain. And Apple's been growing its revenue over the past 5 years at 409% rate. So over a 5-year period, that's roughly about 80% a year. So I like to look at the revenue growth just to verify the growth in retained earnings. If I had a company that was growing its retained earnings at 50% a year, but its revenue was only 10% a year, then then I would be suspect, because you want to see the growth in revenue just to confirm the other fundamentals, and that's a good way just to confirm it. So I like to take a look at that. And then the other fundamental indicator I like to use is I look at the growth in retained earnings. And I'd rather look at the retained earnings than the earnings, because the retained earnings are going to reflect one-time charge-offs and write-offs that may not show up on the earnings report. And it also, the retained earnings are reduced by dividends and special payouts. So retained earnings gives you a little truer picture of the earnings power of a company. So I also like to look at that, and we can get that on Google Finance. Again, you just type in the stock symbol, get quotes, click financials, and then click balance sheet and annual data, and it'll give you the balance sheet information for that company. And it's the retained earnings figures are down near the total equity figures on the balance sheet. And this is towards the bottom of the balance sheet page for any company. So for Clean Harbors, we had retained earnings of $19 million, and then 3 years later, we had retained earnings of $244 million. So again, you can calculate this growth by subtracting the starting value from the ending value, and then dividing by the starting value, and that'll give you the percentage growth. And Clean Harbors is growing its revenue at around a 94% rate. So that I use that again just to verify our other fundamental indicators, just to make sure that that the retained earnings are actually growing. And like I say, that takes into account one-time write-offs that earnings figures may not. So it's a good fundamental indicator. And here's I'm just showing some snapshots of two of my portfolios using the fundamental and technical analysis. And these portfolios had a open trade profit of $528,000, average return of 64%. So I used the fundamental and technical indicators to select these stocks. And here's a snapshot of our stock portfolio from yesterday, and you can see we had $179,000 open trade profits and average return of 84%. And I use the combination of fundamental indicators and technical indicators to select these stocks. And you can see that's been doing very, very well recently, despite the difficult market conditions. So the fundamental analysis and technical analysis can point you to companies with the best profit potential. And there's one more fundamental strategy I'd like to take a look at quickly, and that's our dividend strategy. And with our dividend strategy, we invest in companies who have a history of increasing their dividend, and we also compound the results by reinvesting the dividends in additional shares of stock, and this allows us to compound the returns. And I found that the dividend growth rate is a very reliable forecaster of future earnings growth and the financial health of a company. Of course, dividends are paid in cash, and corporate directors, they're not going to raise the dividend unless they think that the future earnings can sustain that dividend payout. So if they're paid in cash, that's also a great fundamental indicator, because they're not going to increase that cash dividend unless they have the earnings to cover it. So another good measurement of the fundamentals of a company and the overall financial health and the ability of the company to produce earnings growth. So, and then the second part of our dividend strategy, of course, is to reinvest the dividends in additional shares of stock, and this enables us to compound our returns. And here's an example of a dividend stock that I purchased last year, 4,000 shares of American Capital, and American Capital has raised its dividend 166% over the past 4 years. So this was a company that had a history of raising their dividends, and so I purchased 4,000 shares, and then what I do is I set it up in my brokerage account that when American Capital pays a dividend, I automatically purchase additional shares. And as a matter of fact, the dividend for American Capital is going to be put into my account tomorrow. So with 4,000 shares, they're paying a $1.40 quarterly dividend. So tomorrow I'm going to receive a dividend of $5,600, and that will be automatically invested in additional shares of American Capital. And at the current price, that I'll be able to purchase about 190 shares tomorrow. So over the course of a year, I can purchase almost an additional 800 shares of American Capital just by reinvesting the dividends. And again, that allows me to compound my results. And here's an example of what this could look like over a 10-year period if you reinvest the dividends. And assuming that the dividend stays the same at $1.40 quarterly dividend, and that the shares of the stock don't change, then this table shows you what compounding can do. So those 4,000 shares cost me $114,248 after commission. And then if I reinvest the dividends, and again, if the dividends stay the same and the price of the stock stays the same, after year one, I'll have a yearly income of $24,103, and that works out to an annual yield of 21%. And then look what happens after the third year. Now I'm receiving $35,000, 346 in yearly income, and that works out to a 31% annual yield. Now that's cash on cash. So you can see compounding can really increase your returns over time. After year 5, I have a 45% annual yield, cash on cash. So this just shows you the power of compounding. After 7 years, a 67% return. After 10 years, I have 118% annual yield. So again, this is a great strategy. It's pretty simple. There's nothing technical about it. You just simply invest in companies that increase their dividend, and then you reinvest the dividend to compound. So based on this, on my share purchase there, and compounding the results, I'd have 100% return in less than 4 years, 200% return in less than 6 years. Here's a graph of the result of compounding the returns. Again, assuming that the stock price doesn't change and the dividend doesn't change, and you can see the growth of the dividend and the return on the stock. And here's a snapshot of our dividend strategy portfolio as of yesterday, and we have $163,000 open trade profit and average return of 99%. So that's a great return for such a lower risk strategy as the dividend strategy. So you know, over the last couple of years, by reinvesting our dividends, we've been able to accumulate very good returns. And this portfolio tends to have less volatility than our other portfolios because it has dividend-paying stocks. So in volatile markets, there's less price swings in this portfolio than there are in our other portfolios, and this is lower risk than many of the other portfolios. So that's a great return, and the dividend strategy has been working well for us. So that concludes my presentation on fundamental indicators, and I'd be glad to take any questions if you have any questions regarding the strategies.
Chuck, we have just one question in the chat area. Do you see it from Jim Lena?
Yes. Okay, hello Chuck, thanks for this. Do you watch for earnings to time your entries and exits? And no, Jim, I'm not that good. I can't predict any better than anybody else with these earnings, and so I don't try to time my entries and exits using earnings data, because there's just no way to predict how that's going to come out. So I don't use it to enter or exit positions because there's just no way to predict how earnings are going to turn out. That's a really hard game. So I hope that answers your question. Here's one more question for Jim. I noticed that we sold Google stock, but we kept the Google spreads. Any reasons? And that's a great question. We kept the spread because we have downside protection built into the spread if Google stock goes down in price. So we're able to hold that a little longer than the Google stock because it'll give us some time for this trade to work out. And we did a deep in the money spread with Google for just that reason, in case the stock did go down in price. You know, we had a lot of downside protection built in, and it enables us to hold the position a little longer to see if it's going to work out before we have to exit using our stop rules. So that's a great question, and that shows you the advantages of the spread strategy versus a directional trade. The spread strategy has downside protection, whereas a directional trade does not have downside protection. Okay. Okay, I guess that's it. So, here's one more question from Steve. Chuck, we sold an Apple call and created a spread. At what point in time do you sell the call against the spread? Well, Steve, we sold the call yesterday to create the spread. So and if you saw the trade alert, we bought to open the Apple March 400 call, and we sold to open the Apple March 450 call. So by selling to open that call, that created the spread. So I guess that's it on the questions. So I want to thank everybody for attending today, and I will. I'm planning on conducting another webinar in 2 weeks, and we'll take a look at another one of the inner circle strategies. So thanks, everybody. Have a great day.